Hello YouTube investors, welcome to the Independent Investor for Friday, March the 6th. I just thought I'd put out a video basically continuing on with my last video on the ups and downs in the market. It's been a bit of a roller coaster ride, but we're starting to see, as I mentioned at the beginning of February, the market's starting to take the coronavirus and the impacts of that a little bit more seriously. The OECD recorded the corona outbreak could cut global GDP from 2.9% now down to 1.5%, and I still think they're being over optimistic with that. Also, we could probably see Italy go into a recession. Italy has been barreling towards recession, and it's endured 17 consecutive monthly decline in manufacturing now. So it already was in a pretty weak state, and now we know with the coronavirus outbreak there being quite large, it's only going to make matters worse. Monday morning, the markets did recover because they said the coordinated efforts with the central banks around the world to lower interest rates. But I've mentioned before, lowering interest rates doesn't really help the supply side. It might help the demand side, but this virus is a problem on both the demand side and supply side of the economy. And Donald Trump the day before basically chastised Powell for not cutting interest rates. He says people are very disappointed by Jay Powell and the Federal Reserve. The Fed is wrong from the beginning, too fast, too slow. They're even tightening in the beginning and running circles around, laughing at all the banks and the dollars that are hurting our manufacturers. We should lower interest rates in Germany, Japan, and all others. We are now by far the biggest and strongest country, but the Fed puts us at a competitive disadvantage. China is not our problem, the Federal Reserve is, and we will win anyways. And then the next day, the Federal Reserve, John Powell, had an emergency meeting. There was a meeting coming up, I think, in later in March or April, where they normally do any rate adjustments, and he lowered, had an emergency session and lowered rates by 50 basis points, which is a large amount. They usually increase or decrease by 25%, and 50% is the amount, last time they cut 50% was back in the 2009 crisis. It also just looked weak for the Federal Reserve and their leadership. It's meant to be a completely independent body, like the judicial system is in the States from political, and it just looks like this was a bit of a knee-jerk reaction to what Trump said. And as you see, originally the Federal Reserve banks, their main purpose was just to bail out small banks. Back in the 1800s, there's a lot of bank failures. I mean, once people start to take out their savings and their deposits, it's easy for a run of the bank to happen. So they created the Federal Reserve to support those small banks and basically buy any loans or mortgages or that type of thing off them in exchange for cash, and then they could stop the run of the bank. But it's over time, over the last 70 years, 80 years or so, it's become more of a political body, and that they added the inflation rate to its agenda. That was meant to keep inflation rate intact, below a certain rate. Right now they're trying to actually get inflation up to 2%. Then they also added the full employment, using interest rates to keep the economy, unemployment rates low. So this is actually, I think, taking a lot of pressure off like the fiscal side or the politicians. Now they don't have to think so much about the economy and what programs to come up with. If things go bad, they just rely on the central banks to lower interest rates. And that's coming to an end now. As I'll show on some charts, the after this announcement and the scare now, the Treasury bills have just fallen off a cliff, lower than they were. I think the lowest they've been now in like 100 years, or the lowest they've ever been. So this will impact bonds too now. That initially there'd be a capital gain, but that means now on longer term bonds, there will be less of an interest rate. This will force more pension funds into riskier assets, which is not where they want to be right now. Also, there has been talk about European banks being kind of a weak link in the whole financial system. We've heard lots of stories about Deutsche Bank and its solvency, and now with this coronavirus hitting Europe, especially Italy, and spreading, it's just more of a kind of a flag that could come up. We've seen the bank actually index fall quite a bit more than the other indexes, so it's something else I'm keeping an eye on. And oil and gas have just been, just really beaten down. We've seen crude oil now selling at $42 to $46. OPEC can't seem to agree on cuts, so they do agree, then Russia doesn't agree. So it's really affecting, some oil companies are really starting to correct quite severely. And especially in Canada, was already a $10 discount. That means they're down to $30. And for a lot of the shale producers, for a lot of the crude oil producers in Alberta, their profits are going to be severely impacted. And the U.S. shale industry, which really now in the States, they produce almost as much oil or more oil than Saudi Arabia, but this all came about from the shale and fracking industries in the United States. And a lot of this fracking and shale was all funded by lower quality bonds, and we're starting to see now that some of the BB rated bonds are starting to, even though the interest rates were lowered by the Fed, once we start hearing about bankruptcies, then the investors in similar type companies, or to sell those bonds, they're going to want, the new investor's going to want a higher yield, which means the price has to drop. And we're starting to see that. I'll show a chart that came up with today, and it's the BB rated bond yield. And we can see here, it's just, and this is delayed, of course, it's probably higher now, but we're down at 3%, which is extremely low for a junk almost bond. This is below BB rated, and it's been moved up to 5%. But we can see back in the financial crisis, it was in a similar spot, actually lower at 2.5, and it went all the way on a parabolic move all the way up to 22%. So if we start seeing, there's an airline in Britain yesterday that went bankrupt. All the airline stocks were down 30, 40, 50%. We don't know when tourism and travel is going to recover. So some of the smaller airlines and stuff like that might not be able to make interest payments or or repay their bonds as they come up, and that'll just start driving the whole interest rates up on the remaining bonds. And we're going to start seeing a lot, I think, in the shale and gas industry on that, and that's going to start rippling through the whole financial sector. So triple rated bonds is definitely something to keep an eye on. And also notice that one of the junk indexes this week really start to crack and come down. And I read in the Wall Street Journal, revenue losses for global carriers could amount to $63 billion this year if the outbreak is contained. It's looking like now it will not be contained. And then it said it could rise to 113 billion if it spreads further. So that's a substantial amount of money just for one industry. And we could also see, depending how long this goes on, the changing long-term effects of the spending habits of the boomers. If they end up taking a 20-30% correction here, then that's less money, less trips, and things are going to be spending money on for years to come as they try to recover and rebuild their retirement nest egg. So I think the market's starting to look a little further out on this. Also, I have been, you can Google him, but it's Dr. John Campbell. He gives, an English chap, he's on YouTube, and he gives a very good 20-minute update on the virus, how it's spreading, gives stats of each country, gives a little bit of, the science behind a pandemic, that type of thing. And he's